Welcome back. Well, we'll get the pre-open rates in just a bit. For the time being, the SGX Nifty, as we've been pointing out, is suggesting a big gap up. Anuj joins us in the studio as well. Hi, Anuj. Morning. Things are looking positive overnight. How would you trade it?
Yeah, I mean, actually, when they look negative, it's better, right? Like yesterday, when the market gave you that opportunity to buy, today you'll have a gap up. But look, one thing which is very clear from the global setup is that unless you have a big collapse in the US market, our market has now moved on. In fact, it's been the best performing market year to date, and we outperformed the US market by a good 26% this year. I think perhaps the instrument to focus on this morning is Brent crude. That's back down to 91. I think if it goes below 85, you could actually have an all-time high in Indian market. For the day, though, on the Nifty, we are going to open above that resistance of 17,350, but in that congestion zone of 17,450 to 500, which from the risk-reward point of view is perhaps a zone to book profit and not buy fresh, because that's also where your 50-day moving average is. And on the way down, it was a big support. If you close above 17,500, though, with the kind of shorts that we still have in the system, that opens possibility to 17,800, because there's no major resistance between 17,500 to 17,800. On the downside now, of course, 17,250 becomes your sacrosanct support. The bank Nifty is very interesting because it's going to open above 40,000, which is where you had some call writing. And the next congestion zone is straight at 40,500. So I think you have another 500 points opening up on the bank Nifty, which is where you might see some profit taking. Also, today's weekly options expiry on the financial Nifty. So that's something to keep an eye on, because that's an index which, of course, factors in moves from both HDFC Twins and Bajaj Twins. So has all the banks and NBFC. So that could be an index to focus on in today's trade.
Okay, Anuj, thanks a lot for that. So perhaps a Diwali dhamaka coming up on the markets today, this morning, right? That's what the SGX is indicating as of now. But we're going to get our focus on the cement sector, because there's been unusually weak earnings that have come through from a lot of companies. ACC was the one that got hit by elevated costs yesterday. We'll get an analyst in a bit, but in the meantime, I wanted Dipan Mehta's views on this as well. Dipan, we all know that power and fuel costs have been rising, freight costs have been rising. That's hit earnings quite a bit. Do you think the worst is over, and is this a good time to buy, or do you continue to remain cautious in the cement space?
Sonia, we are quite cautious on cement at this point of time, and despite the industry showing significantly decent volume growth, the operating profit margins have compressed, and with the kind of capacity buildup which is taking place, I think short, medium-term prospects and even perhaps long-term prospects of cement remain a bit of a doubt at this point of time. We like to avoid cement. I think better to go for cement consumers like real estate or engineering construction companies. There's going to be a lot of uncertainty as regards price discipline, as regards passing on of cost increases. And the minute you have subpar capacity utilization within the cement industry or new capacities which have come up, that could be a bit of a drag on the earnings. So it's best to avoid cement at this point of time.
Okay, all right. Dipan, thanks so much for stopping by. Wishing you a good day ahead. Well, let's take that cement theme then ahead. Cement earnings, well, they've been very disappointing. The few earnings that we have got so far. Shree started it off. ACC was very, very disappointing, and Heidelberg Cement as well. Fairly disappointing set of numbers. To understand what's going on in the space and how an analyst is reading it, well, Mangesh Badang, the research analyst at Nirmal Bang Institutional Equities, joins in. Hi, Mangesh. Morning. Mangesh, what are you making of it? I mean, ACC's numbers were a howler. Sonia was just asking me in the break that how come they delivered margins of only 0.5%. I said, I'm not sure. I went through 14, 15 brokerages and no one ever came out with even anything like 2 or 3% or even 4, 5%. My question to you is, now the street is looking ahead. Costs per ton have gone up. How much of a relief for the industry expect on a cost per ton basis, say in Q3 and in Q4?
Yeah, good morning, Nigel, and thanks for having me. So when it comes to the cost, I think there should be at least 200 rupees relief in the third quarter, and another 200 to 250 rupees relief in the fourth quarter is what we are currently building in right now. And as you rightly said, the results have been disappointing, and ECC has been definitely been something which is out of whack. We had not expected it for sure.
I think the larger issue, and we were discussing this as well, is that on one hand you have costs going up, on the other hand demand has not come back in a very big way. So how do you approach the space as a whole? Are you cautious, and would it be preferable to stick to large cap cement names versus mid cap? What's the approach at Nirmal Bang?
No, so if you look at demand, demand in the first quarter grew by 17% on a week base. And in second quarter, we are expecting it to be somewhere around 10 to 12%, which is based on basically based on our estimates for the 2Q number. So first half, we would be around 15 odd percent growth. And in the second half, we have a very weak base of last year to work with. So I'll not be surprised if actually the industry turns out a very good demand growth number this year, which would be anywhere between 9 to 10%. And next year is probably the pre-election year, wherein generally we see spending going up. We have already seen sharp impact on margins of cement companies this quarter because of weak pricing as well as cost. And then we are getting into a period wherein busy construction season starts, as well as the commodity cost inflation is coming down. So that should help margins. And obviously, it's not a recovery will not happen in a quarter or two, but definitely the growth or the path for recovery is definitely there, and we expect that the overall margin recovery should go back to normal by the time we end fourth quarter of this year.
Mangesh, I mean, if you have a year, 2 year kind of view, are these which are the good stocks to buy now? Because I mean, you're absolutely right. I mean, pre-election year, usually there is a pickup in infra spending, etc. So, with that time frame in mind, which are the best plays here?
In my opinion, I think Ultratech, if you look at currently, looks really good in the large cap space. We believe that it can easily turn in 10 to 12% volume growth for the next 3 to 4 years, and that should drive its EBITDA. So volume growth would be the key driver, and then you also have this commodity cost coming down, so that should help normalize its margins, which have been weakened temporarily. So Ultratech, and it's trading much below its 10-year as well as 5-year averages of EV/EBITDA multiples. That should ideally be a good choice of the large cap space. And within mid caps, I think we like Eastern region a lot, because we believe that Eastern region demand recovery would be much faster. And Eastern region has had a lot of temporary factors affecting demand last year, which will not be here this time around. So that should be an outlier in my opinion. So Eastern region companies, I think Vivoco is the one that comes to mind. And barring that, I think GK Lakshmi and Birla Corp are the two names that we like from there.
Okay, all right. Mangesh, some of your picks have come up, but I wanted to probe you further on this ACC Ambuja. There's going to be some savings because royalty goes out of it. I think ballpark it should be around 60 rupees per ton of savings, which normally they were paying it to their parent. But this street is also factoring in other benefits to come out, because of the new parentage. They have some expertise in coal mining, they have a port as well. Have you factored in anything? And if you've not factored in, what could that potential number be on a savings per ton for both these two entities?
So Nigel, we have looked at all the cost items of the combined entity ACC and Ambuja, and we estimate that at least 300 rupees cost saving should be possible for Adani Group. In fact, large part of that should come from the initiatives that have already been taken by ACC and Ambuja. So they are in the process of adding almost 80 megawatt of WHRS system, waste heat recovery system, which should aid in lowering the power and fuel cost. Those are already started commissioning, and that should give some relief next year. And along with the technical know-how fees going away, the addition of WHRS, and then there is addition of another set of renewable power and the coal expertise that Adani can bring in, altogether can bring in 250 to 300 rupees savings.
So your 300 rupees is factoring in both what the erstwhile promoter did as well as what the Adani Group can do, right?
So actually, we would wait for at least some commentary from the Adani Group to make a further assessment of our estimate. But as you know, we have not heard anything from the new management, and we would probably wait and see once they settle down.
Okay. Finally, what does one do with a name like Shree Cement? I mean, this year has been a year of wealth destruction for Shree Cement investors. I think at the start of the year, the stock was somewhere around 27,000, and it's now almost, ready to break 20,000. What are your thoughts on whether one should keep buy the dip here in anticipation of any revival, or do you think that, just staying away is the best option?
Yeah, so Shree has been a darling of the investors for a pretty long time within cement space. And, generally this has been the highest multiple stock in terms of valuations. The valuations have come off recently. That is because the volume growth that you expect from Shree, as well as the capex intensity that they have in terms of adding capacity or adding plants ahead of time, has been missing somewhat. And what we have seen is that the last two capex that the company had done, there had been some delay. But anyway, Shri remains one of the best performing cement company within the industry. And we believe that even though temporarily EBITDA growth is on the lower side, we should see the company bouncing back. And in fact, if you look at most of the other numbers as they come out, you might see that Shri had actually given a really good set of numbers. So we'll wait and see. But no, we factor in a large volume growth for Shri and give a relatively higher multiple, but the upside remains very limited. So we have a great rating right now on Shri.
Yeah. Okay, all right, Mangesh. Relatively, yeah, in comparison to what the other companies have done, Shri's numbers actually look blockbuster, when you have ACC delivering less than 1% margins. Thanks so much, Mangesh, for joining in. And as you said, Shri Cement has been a darling for investors. It seems they're on a bit of a break with, market participants, at least for this year, because it's been a rank underperformer, good pedigree company. Unfortunately, things have swung against them, and that's why that has been a big underperformer. Mr. Bangur as well. Every time I probe him, I said, what's your take? I mean, he said that over a longer time, we have given good amount of returns to shareholders. So let's see whether or not the next decade as well could belong to that.
And actually, to be fair, volume growth was not bad at all.
Yeah.
I mean, 18-20% volume growth in a challenging market like this is no mean feat. But we take Mangesh's point that relatively these were a better set of earnings, but the street doesn't seem to think so. Let's do one thing. Let's get back to the market now. We have about a couple of minutes left before the market opens. Looks like it's going to be a very strong opening. Z Entertainment is your big mover on the upside, up 6% after that large block deal that has taken place. And a couple of other stocks as well do deserve mention. Tata Coffee, weak numbers coming in there. Maharashtra Seamless, good results. Gujarat Gas and other city gas distribution companies also in focus this morning. But let's get Mitesh on board to tell us what he's watching. Mitesh, what's the big call at 9:10?
Yeah, I think I'll go with a buy on ICICI Bank with a stop at 877 for targets of 909.
All right, fair enough. ICICI Bank in focus, 896, almost 900 actually. The pre-open, of course, is behind us, and we'll get back to some more rates in a bit. But Gujarat Gas should be in focus. Sonal is here to tell us why. Sonal.
Well, Gujarat Gas is in focus because the Gujarat government has cut taxes on CNG and PNG by 10% to 5%. That would mean that CNG prices can be cut by 5 rupees per kg and the PNG prices by 4.3 rupees per SCM. So this will allow company to actually cut those prices and pass it on to consumers so that their volume growth is improved, because it has been under pressure because of higher prices as well. Additionally, JP Morgan has come out with a note on city gas companies where they have initiated coverage on all the three stocks. They initiate with an overweight on Mahanagar Gas, an underweight on Gujarat Gas and a neutral on IGL, and the target prices will come up for you on the screen. They say that they struggle to see CGD companies expanding margins further on from here because of higher APM gas prices. There is also downside risk to volumes at current levels, and they do not see PE multiples reverting to older, higher levels unless the LNG prices, they fall sharply to less than $10 per MMBTU, which are currently around $30 per MMBTU. So they are not very positive on all these city gas distribution companies because of higher gas prices.
Okay, thanks for that. Well, Concord delivered a good set of numbers as far as the Q2 volume update was concerned. Mangalam is here to give us the lowdown. Mangalam.
Well, the good set of numbers for Concord's Q2 volumes came in from their EXIM division, which is the larger part of their business, 18.5% out there. Could have been, a function of a favorable base out there too as well, because same time last year, the EXIM volumes were weak. On the other side, the domestic volumes, which were strong for the last few quarters, have now seen a reduction in the pace at which they're growing. So that is coming at around 9.8%, as a result of which the overall volumes for the business have grown at 16.6%, understandably because of higher contribution coming in from EXIM. This takes their first half year volumes to around 9.3%, just below the management's guided band of 10 to 12% for this year. So important to see whether volumes will pick up in the second half, as they do every year as well, to finally go into the management guided band of 10 to 12%. However, the important part for Concord will be what happens with privatization, because now we've gotten some clarity with regards to the land license fee as well. There has been a clarification issued with regards to whether they want to continue it for 35 years or not at the existing rates instead of bidding for lower rates, etc. as well. So with this policy clarification, the best thing to watch out for in terms of a trigger would be privatization.
Okay, all right. Mangalam, thanks for that. Stock opens up with a gain of around 1%. But let's go across to Sonal. Sonal, Oberoi Realty, yesterday the stock got clonked. Do you have some con call details as well?
Yes, the commentary from the management was quite positive. They said that they have recently raised prices to the tune of 5 to 10% across their luxury projects like Elysian, Sky City and Enigma projects, and they are going to push forward with across-the-board price hike from third quarter as well. So in terms of realizations, they are expecting some good numbers to come in, and they are going to resume new launches from the second half after a gap of 3 quarters. So that is something which will push their sales higher as well, because this time around it was driven by one-time sales from super luxury project as well. Debt this time around was higher because of investments in lease assets and project acquisitions as well, but they think debt is at a manageable level for the company. On the back of this, Jefferies has upgraded their pre-sales estimates by 9 to 13%. They have upgraded their earnings estimates as well by 5% for FY23-24, and they think that the NAV will rise by 6% to 870 rupees per share, and that's why the higher target price on higher pricing, and they have rolled forward their estimates as well. Ambit has increased their pre-sales value by 5 to 20% for FY23 and FY24 because of the new launches that the company is talking about. So all in all, could be a green for the stock today.
Okay, Sonal, thanks very much for that. Oberoi sold off yesterday, so we'll see the pickup maybe today. The other one is Canfin Homes, which, you know, the reason I'm mentioning that is because it's the cheapest sort of housing finance company. The long-serving top boss at Canfin Homes has left. And this is the first quarter result after that development. And there was a lot of confusion, a lot of anxiety over what that development would mean in terms of financials. Would there be a large hit? Would there be large provisioning? Will numbers all go south? None of that has happened. I mean, numbers are largely in line. There is a little bit of margin pressure which has come through. So we'll get to quiz the Canfin Homes management later, but that is the other one which I think you should watch, along with the stocks we highlighted. And of course, the other one is Z, which we've been talking about from the word go this morning. Just about, 10 seconds to go for market open. Sonia.
Absolutely. And Z, I think in pre-opening is now up almost about 6% but gearing up for a positive opening this morning. The Nifty is now up 126 points, so big bang opening on the Lao Street. The Sensex is up about 440 points in tandem with what the SGX was suggesting, as well as what the global markets had thrown up. Green across the screen, and remember, there are a lot of levels to watch out for. The 50-day moving average is approaching 17,491, so that seems to be the next hurdle on the upside. Let's see if the market can conquer that. Almost 1% higher now on the Nifty, led by a lot of these IT stocks. Wipro, HCL Tech, Infosys, TCS are all in the green by about 1 to 2%. Then you have Tata Motors, Hindalco, Ultratech Cement. There's banks. The Bank Nifty is up 360 points, so that's a % gain. Big outperformance coming in from there. SBI, ICICI Bank, IndusInd Bank are your top movers in the Bank Nifty. You have some participation coming in from FMCG, HUL, ITC. HUL actually ahead of its numbers this week is up about 1%, so keep that in mind. And auto companies are looking good. Eicher, M&M, Maruti are all in the green, and Tata Motors, of course, as I mentioned earlier. Ultratech Cement is also charging ahead, so 2% higher on Ultratech Cement. The cement analyst just a while back was telling us that Ultratech Cement is one of his top picks in that space. The only stock that is in the red right now is Coal India. So a tad bit, I mean, nothing alarming there, just about 0.2% in the red. But otherwise, it is a crackling opening this morning. The Nifty up 150 points now.
Well, it's a cracker indeed. Good to see, the Nifty is keeping in pace with what the SGX Nifty did suggest. And yesterday, one bit of a sore thumb was that, in fact, the mid-cap index didn't participate. At least today, for starters, it's keeping, more or less in pace. It's up close to around 0.7%. Few stocks that are moving around. RPG Life, numbers look pretty good. The stock is up close to around 3%. You have Maharashtra Seamless. It's been a big outperformer, actually. And those numbers look splendid. That as well is holding high with a gain of around 2%. Tata Coffee, the numbers looked a little bit subdued, but that as well, I think, has managed to move into the green. It's trading more or less flattish, up 1% odd. Jindal Drilling, well, we don't talk about this one very often, but those numbers look pretty good. Net profit number jumped up big time, close to around 10 times on a year-on-year basis. So that stock is up close to around 3.5% odd. Other stocks, that you should keep your eye out on. Tata Metallics, the numbers looked weak. The street, though, is optimistic. Second half of the year, things could recover. So that one, for starters, is down close to around 1%. Canfin Homes has pulled back a little bit to kickstart trade. And Aster DM, they have a JV for pharmacies in Saudi Arabia that they've just announced. So that one as well is opening high with a gain of around 2.5%. Suzlon yesterday was up close to around 10%. Today, it's seeing some follow-through buying on very, very large volumes. So keep an eye out on that one as well, up 2%. Prashant.
So it's a great open, 130 points higher, 17,445. I'm just trying to spot what else is moving. There is a TCS, which is recouping. That's a very, is it my screen or is it generally a pretty low kind of start, low volume kind of start? But let me just kind of refresh this. I think it is. So TCS, yes, it is doing well. ICICI Bank, I think it was one of the trades which was mentioned earlier, which is looking up as well. HDFC Bank is the other one, which is starting higher. Wipro is making a bit of a comeback. I think that should come up on our screens as well. And then kind of we'll pick up from there. Now things are actually starting to pick up. What we'll do is we'll just give it some more time and then come back with sort of more rates on broader markets. Sonia.
Diwali break, you know, starting today. There are schools going on breaks, and
we are here. Feel jealous.
We are here, but people like to celebrate, and this has been a year. I think there's a lot of celebration after many years, right? So people sort of traveling, meeting their loved ones.
Oh yeah, the first full. It was the first full kind of summer season.
Full-blown Diwali after
absolutely.
COVID. Yeah.
I mean, people are out and about like how. But yeah, I mean, you know, things are now picking up a little bit more, but there's no outsized mover as far as I can see on the upside or downside. Motherson, I think we mentioned already, 6% lower, and Tata Elxsi is just follow through, is a bit of follow through, 1.5 lower after yesterday's 8% cut. That we had. 150 points on the Nifty, 17,464. Tushar Pradhan is our market master today. He's Chief Investment Officer at HSBC Global Asset Management India. Tushar, great to have you with us here on the program. Thank you very much. So, you know, the global stuff is kind of impacting us to a much lesser degree. And as time has gone on, the level of bearishness as far as just purely US is also starting to come off. You know, how much more will people sell, even US stocks? So does that open up a window for a clean run of outperformance here? If US starts to sort of behave itself, maybe goes into a bit of a time correction and no great price damage from here? What's your sense?
Yeah, I think interesting points you make there. But you have to remember that the US has had a very significant drawdown. We don't notice it because our markets have not fallen so much. But if you look at the damage in the US, NASDAQ especially, you will find that there is significant correction in the stock markets. And to say that the US markets will time correct from here, I would actually argue that they might bounce back because the steepness of that correction is so large. I think what we are all waiting for is some cue from the Federal Reserve that maybe the inflation number is speaking, that they have probably had victory over it. And they will now start to look at the prospect of slowing industrial production. And possibly the number they're also looking at is increasing unemployment. Once that starts to happen, I think the Federal Reserve will definitely need to cut rates. And the cutting cycle, clearly, as we all know, is very, very positive from an assets valuation perspective. So I think what I think from here on could be is that the US will also bounce back. But the timing, of course, is something that we don't know. And once that starts to happen, obviously, that has a pretty good impact across all markets. And I think our markets will also benefit from there. So I think very interesting times ahead of us.
Okay, interesting times and good times, it seems like, because the Nifty is now surging ahead, 160 points higher on the Nifty. The Bank Nifty is up 320 points and it's a 1% rally almost on the index right now. Led by a lot of these IT names, Wipro is now up almost 2%. TVS Motor, we were telling you about that earlier, a double upgrade over there in the last 2 days. 2 upgrades rather, so 2% higher on TVS Motor. Zomato is making a bit of a comeback. Adani Power is in the green, so plenty of stocks to look at. Tushar, good morning and greetings of the season to you and your entire team at HSBC. This has been a good one. You know, it's a comeback after COVID and a lot of retail participation is back as well. Wanted your thoughts on how you've read into earnings season so far. It's early days yet, but good numbers coming through from banks, not so bad from IT. Your thoughts?
Yeah, no, I think we have been predicting pretty significant earnings growth for this quarter as well, and in fact for the full financial year. So I think the dark clouds that we have seen in the Western world and the markets as we speak have caused us to believe that earnings will not follow through. But I think the earnings story is pretty solid for this year. what brings to mind then is that will this be followed up for next year? And I think that is really where the confusion is. How long will the higher interest rates survive? Will it snuff out the capital expansion that we are talking about, which will happen? Or will the rates which have gone up in India not really be so substantial to be able to really snuff out the recovery that we are talking about for next year? So a lot of uncertainties there. I would place my bets on the fact that if we have growth, then higher interest rates are unlikely to damage our story, and which would mean that earnings growth will continue strong into the next year. The other impact that we also have to remember may happen is that if global metals, global materials continue to remain a little subdued because of the lack of demand in the Western world, then in some way it benefits India because the import of these metals into the country clearly come at a much more discount. And on the other hand, the consumer discretionary, the manufacturing sector then generally does benefit from here also, which also means that earnings can remain in positive territory for quite a few quarters going forward. So I would think that I'm pretty positive on earnings growth in India continuing. And this quarter has been a little bit of a surprise only because our vision had changed a little negative. But in spite of that, I think the earnings recovery is likely to sustain, in my view.
Okay, all right. Hi, Tushar. Morning. If earnings recovery is going to match up, then the banks need to do well, right? And there's a consensus trade here in India. I was looking at the global peers as well. There seems to be a bullish sentiment in all these banking names. Overnight, we had Bank of America that came out with a good set of numbers. But, do you think that since banks are expected to do well, it makes sense now to look at some of those PSU banking names? They've been underperformers. Valuation-wise, they're giving some bit of comfort. And we have a sell-side note today from Haitong Securities. They are positive on it. Your take?
Yeah, I think it's a matter of choice. I think there is enough in the market to kind of bracket yourself to saying which is the less risky ride you would like to take. I will mention only this, that the private sector banks have done well for the reasons that we all know, that they bring technology, they bring ease of banking, ease of business to customers. Customers tend to like that. The kind of expansion that they've seen both on the liability side as well as their ability to attract more customers is the testament for where their market valuation is going. The innovation by which they approach newer customers and the ease at which people can be lent to is something which a lot of the public sector banks need to catch up on. And I think the market is giving it a multiple, knowing the inherent strength of these business franchises, and not because they are PSUs and they should deserve a little better or anything like that. I think it is just hard fundamentals on where the market is viewing it. Yes, there is valuation comfort on the public sector side. And in fact, if any significant company turns around, invests dramatically in technology, matches step for step what the private banks have been able to offer its customers, I think you've got a gold mine. But it has to be selective, it has to be management-led, it has to be strategy-led. And for that, we need to wait and watch which public sector company actually takes that initiative up.
But Tushar, sorry to come in here. I just wanted to, confirm that you're in the camp that believes that those PSU banks, they deserve a second chance, right? I mean, they deserve a look at, given the valuations, given all that you said.
I would say that the valuations clearly point to something which is comparatively attractive. That is all I can say. However, I mentioned that they will remain attractive if they do not do anything about their franchise. Okay. If they do not take seriously their intent of market entry, of their ability to attract more customers. If that's not the case, the market is not going to reward you just because you're cheap.
All right. By the way, the Nifty is hit its 50-day moving average, which is 17,491. The day's high is 17,493. So it got to slightly above the 50-day, and now it's kind of come off. So that remains the level to take out, as we were highlighting in the morning. So you opened with a flourish right at that level, and now just trading under it. Could this be a bit of a trending kind of session? We'll see. Tushar, IT services is the other one, which again a lot of debate around that one. But what would you do there? Would you want to get some exposure now? Have you been positive, constructive? Tell us.
Yeah, IT has been a little bit under the cloud because of the sentiment, I would think, because everybody expects the US to go into some sort of slowdown. And clearly, the ordering is a measure of how strong and how positive the US corporations feel about infrastructure, about IT itself. And IT services in India are a clear beneficiary of that thought downstream. And as a result, the clouds around what to expect out of IT services had become a little dark. But I think we need to also understand that there is a lot of IT infrastructure which is BAU, which means that it will continue no matter what happens. And the kind of spending that is going to likely come will also, continue, which means that the robustness of earnings for IT services, especially the larger companies, will sustain. However, the margins, because of what we have seen as wage inflation in India, as well as the fact that the fight for talent, as we call it, has become pretty intense. And the smaller and the mid-sized IT companies are always vulnerable to changes in growth trajectory. So I think one has to look at it a little bit in a nuanced fashion. There are businesses which will sustain this slowdown in the US no matter what, and the earnings will rebound. On the other hand, there will be companies which will have an impact of the slowdown, and they will clearly struggle by way of margins, as well as the fact that their top lines may not really generate the kind of excitement that some of the other companies will do. So it's not a blanket yes or no, but I think there is enough opportunity for us to poke around.
Okay, all right. Well, we will leave it at that. All the best. Happy Diwali to you if we don't speak before that. Have a great Samvat. And thanks a lot for joining in on CNBC TV18.
Happy Diwali.
That's the word coming in from HSBC Global. By the way, the market is piling on the gains, and how. It's not just the headline index, but plenty of stocks in the broader markets actually picking up pace. Aster DM is now up almost about 3% after signing that JV in Saudi Arabia to start pharmacies. TVS Motors now almost a 3% gain over there. India Mart is coming back. I mean, it's had a very rough year. It's down 30% this year. But today, India Mart is up almost about 3%. And something like a Deepak Fertilizers also has been a big mover. But Blue Star is the company on our radar. Phillip Capital put out a very interesting note. They initiated a buy. They spoke about a target price of $14.51 on Blue Star, which is a big upside. Their key thesis of a buy is that they expect a revenue growth of 17% over the next 3 years, and this will be led by market share gains across segments for Blue Star. So let's speak to the management. We are joined by B. Tyagarajan, the MD at Blue Star. Mr. Tyagarajan, good morning and happy Diwali to you in advance. Hope this is a better one than the preceding couple, because we've had very challenging times. But do you concur with this view that an analyst has put out, that Blue Star is expanding its presence and hence gaining market share across categories, and that could perhaps help you to do at least a 17% compounded growth in revenues over the next 3 years? Is that a doable target?
Good morning, Sonia. Happy Diwali to you and your colleagues and audience. It's a pleasure to talk to you. Indeed, it is a very bright and exciting Diwali season. I will not be able to comment on the valuations or something that is entirely up to the market to decide, analysts to predict. The growth prospects are immense. In that respect, I think that growth that is indicated there, we may even exceed that. It is probable. I am saying this because of the room air conditioner segment, the penetration, what is there today, it is rapidly going to increase. That I would expect the penetration from the current level of 7 to reach up to 10%. Then the India market, if you recollect, from 2003 onwards, air conditioners consumption started moving up, and many units are coming for replacement. Today, the replacement market is negligible. And I think close to around 1.5 million units will be coming up every year, and you can see it will rapidly grow. In about 3 years' time, around 10 to 15 million will be replacement market alone. So there is the other part of it. The third is the infrastructure push, whether it is a metro railway or airports or the other social infrastructure that are to be built. Like you are looking at hospitals. We need quite a few hospitals. We need even hotels and convention centers. So I am seeing great growth happening there. And the manufacturing capacity expansion cycle. So the manufacturing sector has opened up huge opportunity. Data center is a big growth story. Now come to commercial refrigeration. We are not even at 1% of what this country needs. And the ice cream, processed food consumption, whether it is fruits, vegetables, other perishables, and the export opportunities that are being pursued by the processors, that is opening up a great opportunity. In fact, CAGR of 17% should be doable, and in fact, it can even be exceeded.
Okay, all right. All right, Mr. Tyagarajan, got that. And wishing you a happy Diwali. Your initial comment suggested that it's been a good start to the season. Though for you it's off season, but I think you're comparing it on relative terms. I wanted to ask you about inventory in the system. Some reports indicate that the old BEE rated, inventory is rather high in the system. Could you confirm or deny that, and your sense on the inventory situation for the industry?
I think that will not be much at all, because the energy label change took place in July. And if you recollect, summer started off very well. March, April, and May first half showing a phenomenal growth, but it tapered off. Therefore, there could be some inventory, but I don't think post-Diwali, the old energy label products will be existing in the system at all. But the truth is that the inventory level overall, including the raw material and components, would have substantially gone up because of the supply chain disruptions and what we need to plan for the season ahead. So we are all, if it is 45-day inventory, we are ending up holding around 75 to 80 days worth of inventory. So therefore, raw material components inventory is of very high order. The only item that may not be stored that much may be metals, because the metals you see the downward trend. Otherwise, quite a few components, including semiconductors, are being ordered in advance for mitigating the supply chain risks.
Okay. All right, Mr. Tyagarajan, so you're not too worried about the old BEE, that's the energy efficiency rated, inventory. You're saying that's likely to settle down. What about the new BE rated, pricing? How much is it higher? Has it been pushed through?
No, the price increase has not taken place from July 1 at all, because if you recollect, there was a benefit coming out of the commodity prices softening, and then off late you are seeing the rupee depreciation. In effect, there may not be any change in terms of savings or in terms of hiking. So there is no price change that has been implemented. My sense is that all the players will review the prices somewhere around February, building up to the season. That's what will take place.
So, Mr. Tyagarajan, how is this quarter? How is the quarter going to be? How is this the third quarter, in your assessment, going to pan out as compared to pre-COVID levels? I mean, could you give us some indication? Where are we at compared to pre-COVID levels, both for room air conditioners and the commercial segment?
The commercial segment, B2B, will be doing phenomenally well because there is huge rush for executing the projects. Manufacturing, infra, data center, there is great speed with which these projects are being executed. Room air conditioners, I think it will be at the pre-COVID level. In any case, it is a very, very lean season. As I told you earlier, that 15% of the revenue of room air conditioners should be coming in this particular quarter. The real pickup should be from January onwards. So I don't see a demand drop. I do not see a huge boom taking place in that segment, but B2B part of it will be a huge rush to get the projects executed.
Room AC segment particularly, you said that penetration is quite low now, it's 7%, it's expected to go up to 10%. What is your own market share currently and how much do you think it can grow by? And also trying to understand whether there's any operating leverage that you can eke out. When do you expect your margin, because margins are still at, low single digit. When do you expect it to get to perhaps high single digit or even double digit margins?
So the it will come out of scale. So we have to grow faster than the market. We have stated this, that we would like to be at 15% market share from the current level of 13% by FY25. That is the goal. So for the coming years also, we will maintain that growing faster than the market. The second part is repositioning the product and making the product affordable. And this work is through investments in R&D. Substantial investment is going on there. So we have done it well last financial year. We have been doing it well this year. We will continue to do so. The third one, operating leverage, apart from scale, I think it will be through the commissioning of the Sri City facility. There, the southern market, you have got some logistics savings, both in terms of incoming raw material as well as outbound. I had again disclosed this to your own channel that there may be a benefit of around 4% to 5% through logistics alone, because all the 6 states in the south can be served overnight. Today, we are dispatching it from Himachal Pradesh to serve the southern states, actually. The next one, I had pointed out again last time, the advertising expenses as a percentage of the revenue has been coming down dramatically, because the scale is being built and there is reasonable awareness on air conditioners, and that digital medium is being leveraged adequately. So I think there is a leverage of at least 1% of the revenue in terms of advertising expenses.
Okay, so
But
what
then,
does this mean for overall margins? I mean, you said 15% market share by FY25. You said 17% plus compounded growth in revenues over the next 3 years. But on the market share, on the margins, any target that you'd have?
we have maintained always. We will be very happy if EBIT margin of around 10% is maintained. We have done it in the past. We have done it in Q4 always, or the summer season. So that's what we will look at it. This year, summer, you had a difficult time because of the unprecedented commodity price hike. So if we would get back to 10% EBIT margin in the long run, we would be very happy. That's what we are working towards.
All right, Mr. Jagarajan, great to have you with us here always. Thank you very much. And look forward to speaking with you again to get an update. The commercial segment is doing very, very well. That's something that, the management of Blue Star has maintained for the last couple of times we've had them on the program. 0.8% higher. We've got the market up 156. After testing that 50-day simple moving average, the market's come off a little bit. It's staying there. Z is doing very well. It's up 4%, 274. The other one is Deepak Fertilizers, which is seeing a follow-through move. It was up 8-9% yesterday. It's up strongly now. The new listing from yesterday, which is Electronics Mart, that is up 4%. Another 4%, that is 88 on that one. TVS Motor, Sonia highlighted that earlier, 3% higher. Data Patterns, again, very strong mover in the last hour yesterday. It's up 5%. So these are kind of follow-through moves we are seeing. And Garden Reach Shipbuilders saw that huge sort of re-rating. Yesterday, it saw profit booking. It was down, I think, 7-8%, but it's come back again, at least trying to come back with about a 2% move right now. Campus Footwear, 3%. India Mart, we highlighted earlier, so on and so forth. So that's the broader markets for you. 3:1 in advances to declines with 20 minutes of trade behind us. We'll take a quick break here. We'll have Lalit Agarwal of V-Mart Retail to discuss a very interesting acquisition they've made. Of course, we'll get a sense in terms of how business and sales are doing in Tier 2, Tier 3 cities, markets they operate in. We'll also be speaking with Abneesh Roy of Nuvama Group to discuss expectations from the FMCG sector a little later. Stay with us.